Thank you for joining me. I'm Alex, and I would like to have a look at Charles Schwab. I'm not really sure how you can say that, and I'm not going to repeat that because they are going to buy TD Ameritrade. Why not America Trade? Anyway, so I figured I'd like to have a look at that, and maybe tomorrow I'll look at TD Ameritrade and see what they do. Still easier to say than Charles Schwab. So their brokerage, their price currently $49, and that gives them a market cap of $63 billion. Dividend yield 1.38%, which gives them, or with a payout ratio of 23%, which is, it's not great. It's not terrible, but it's definitely not great. Revenue $9.9 billion, earnings $3.5 billion, which gives them a PE of 18. And both revenue and earnings steadily increasing. Earnings much more than revenue, obviously, but for the past 3 years. So definitely very good there. Total assets $296 billion. Total liabilities $276 billion, which gives them a total stockholders' equity of $20.6 billion. There you go. So obviously, much assets, much liabilities as banks and brokerages tend to have, because they don't deal with anything production related, so they need assets to make more money. So to sum that all up, PE of 18 is certainly decent. Balance sheet, not a huge fan, but it's certainly not terrible. So I can definitely live with that balance sheet. Revenue increasing, earnings increasing much harder, and they have a dividend even though it's not much. So all that combined for a value investor looks very enticing. For a growth investor, I think you probably want to look elsewhere. But for a dividend investor, I would expect, especially with the revenue growth and the earnings growth, that the dividend yield is probably constantly increasing. So I think it would make sense to open a position in that and hold it for a very long time, because the chances are they're not going anywhere. Unless Robinhood disrupts the market so much that pretty much all the traders' fees go away. I don't think they're going anywhere, especially with all the focus on retirement accounts and stock market accounts that you have in the US. So, fairly safe business model. I do see the potential for disruption in with internet trading, and as I mentioned, Robinhood. There are several others that have free trades, that have an app with an online platform that kind of shifts the whole stock purchasing process for the very beginning investor. But for the bigger investors that have their portfolio, that do their research, that do everything, I think there's going to be a place for people like Schwab and Ameritrade and Fidelity and Vanguard. So don't see too many risk factors right now. I don't see that Robinhood can really disrupt them really fast, even though the fee schedule did shift a lot. But overall, I would say this is a fairly safe investment with decent growth, decent earnings growth, and very good balance sheet. So for a value investor, I think that's pretty safe investment. Obviously, dividend helps, but PE is good. The balance sheet is decent. And overall, I think for a value investor, it makes sense to buy them. For a dividend investor, slightly less so, but still, with everything being safe, I think that for a dividend investor, this also makes sense. For a growth investor, obviously it doesn't, but there's better opportunities out there. That's it for me for today. If you like this video, make sure to subscribe. I'm coming out with more videos every day before market open. I hope you have a successful day.